business owners, are you encountering these problems with lightning frequency? Confronted with negative cash flow, lacking liquidity to satisfy vendors, employees, and customers, flushed with debt stock, banks refusing to lend on your profile, caught in debt trap, scared of insolvency sooner rather than later, then how to salvage the situation? Better realize fast and never forget, cash is king. It all boils down to creating an efficient cash flow management. Hi, I'm Chanakya Shah. Welcome to my YouTube channel of Finance and Business Coaching. I'm a chartered accountant, entrepreneur, founder, and CEO of my outfit, Holistic Business Consulting. I have 15 years of professional experience and have serviced more than 500 diverse clientele. Cash is king. Cash flow rules the crest in total financial health of the company. A company can have huge number of accounts receivables, yet it can run short of cash to make purchases, pay wages, and invest for future. Unless accounts receivable are converted into cash promptly, company can fail and become victim of bankruptcy. Paradoxically, such a situation can arise in spite of enjoying positive net worth. How important is cash? Cash empowers you to hire the best talent for business. It strengthens the purchasing power for goods and services for business growth. It helps to capitalize on emerging business opportunities. Cash flow projections steer the company in the desired direction of business growth. Let's now understand preponderance of cash over turnover or profit. It is without an iota of doubt that business turnover matters to business owners. However, turnover reflects picture of financial health of the company. What matters more rather than the turnover is cash flow, which remains at the heart of every business operation. Just allow any imbalance in your cash flow and you add it. Starting from small businesses to large MNCs, liquidity is of paramount importance to meet obligations to the creditors. What is cash flow management? Cash flow management means the process of monitoring, analyzing, and optimizing net amount of cash receipts minus cash expenses. The flow of funds should always be greater than the outflow of funds. This is the way to generate surplus. Business owners must always maintain a positive cash flow. Cash flow management involves knowledge regarding when, where, and how cash needs arise. Knowledge regarding best sources for meeting additional needs. And creating good relationship between debtors and creditors. Why insist on efficient cash flow? Cash flow management is a measure of liquid assets of the business. Accurate balance of cash inflow and outflow is required all the time. Negative cash flow suggests that the expenses of the company are too high. And efficient cash flow management helps the company to identify unexpected crises looming large. Now look at the objectives of cash flow management. They are to ensure company does not invite cash shortages and avoid long-standing debtors on the books. Benefits of cash flow management. Number 1. Solvency and creditworthiness. Positive cash flow improves credit rating with the bank, while lending banks are sure of safe and secure returns of funds deployed. Number 2. CapEx and investment. Without comfortable cash flow position, surplus funds are deployed to reap returns, This helps money making more money. Number 3, boost vendor management. By maintaining timely balances of receivable and payable, a business is able to honor its vendor commitments in time. Relationship of trust is built up with vendors. Consequently, business owners are able to negotiate better terms with satisfied vendors. Number 4, boost employees' morale. Timely disbursement of wages and salaries to employees instills motivation and avoids frequent attritions. Now, how to analyze cash flow? A detailed analysis of cash flow on weekly, monthly, quarterly, and annual basis reveals cash in hand, total receipts and cash payment, production expenses, amount of cash for goods sold. Ways to manage cash flow. It is essential to prepare a cash flow statement on weekly, monthly, quarterly, and annual basis. In this context, following steps must be taken. First, you forecast the expenses, then forecast the revenue, assimilate the data, and update the projection spreadsheet. Cash flow projections. While preparing cash flow statement, you must take into account the following factors. The factors are components of a cash flow statement. Those are operating activities, investing activities, and financing activities. How will you overcome cash deficit? You could by applying for loan from banks, institutions, or individuals, applying for line of credit from banks, speeding up collection process, purchasing equipment through lease financing or loans, liquidating assets, delaying payment to vendors. Then what are the ways to improve cash flow? Focus on inventory control and get rid of dead stock even at a discount. Lease rather than buy to stop blockage of cash. Send out invoices on demand. Offer discount for early payment. Identify alternative streams of revenue to ease pressure on top line. Check new suppliers and offer early payment discounts. Increase prices in line with competitors. To avoid cash crunch, you must watch accounts receivable to find out duration between creating invoice and receiving collection, and this needs to be reduced. Accounts payable to find out duration between accepting the invoice for purchase and when payment is made, and this needs to be increased to the extent possible without affecting credibility. Inventory, duration between payment for materials and depositing the cash for the sale of items. This needs to be reduced. Cash flow management helps to, number 1 is to predict shortfalls. Number 2, to reduce stress by remaining prepared for any contingency. Number 3, to know when to grow with cash on hand and how to earmark for business growth. Then what are the essential steps in the process of cash flow management? Create a list based on sales growth estimate, price increases from suppliers, seasonality, wage increases, and general cost increases. Jot down anticipated sales income based on industry trends, internal price changes, economic factors. List the estimated cash inflow like government grants, tax refund, loan proceeds, or royalties. Prepare a list of estimated expenses like wages and salaries to staff, purchase of asset, loan repayments. Consolidate cash inflow and outflow to arrive at a net cash flow position. What are the ways to maintain positive cash flow? Maintain some cash reserves to protect yourself from any unforeseen contingencies. Track income and expenditure to maximize your business growth. Prioritize cash flow for your business and for customers. Cut your costs by minimizing your outgoings and increase your prices with reasonable doses to survive and grow both in short as well as long term. Strategic areas in cash flow management. Give incentives to customers to settle invoice promptly. Leverage escrow services to protect cash during high value transactions. Eliminate wasteful expenditure. And explore finance or hire purchase options in large investments to overcome cash squeeze. Regular monitoring, reporting, and forecasting of cash flow puts businesses on profit and growth trajectory. Cash flow management entails constant diligence, regular reporting, and a tight grip on expenses. Failing in this vital element can drive business of any size or dimension to insolvency, debt trap, diminished profit margin, and liquidation. There are formulas for calculating cash flow. Business owners are advised to apply the relevant formula for calculating cash. Number 1 is the free cash flow. This formula refers to resources available for distribution among the stakeholders. It is calculated by free cash flow is net income plus the depreciation or the amortization minus change in working capital minus the capital expenditure. Number 2 is the operating cash flow. This formula indicates the day-to-day cash flow within the business. It is calculated as depreciation plus operating income minus the taxes plus changes in working capital. Then moving on, cash flow forecast. This formula indicates the cash flow position for a week, month, quarter, or year. Cash flow forecast is nothing but beginning cash plus projected inflow minus projected outflows, which is equal to ending cash. To conclude, never ever take your eyes off the cash flow. Maintain a strict vigil over cash flow management. It will turn out to be a solid recipe for the financial health of your business. Always remember the words of David Tang. The 3 dreaded words in English language are negative cash flow. Isn't it so essential to propel your business to the next level? In case you're facing any challenges relating to cash flow, kindly schedule a meeting with us. If you're interested in this channel, make sure to subscribe and click the bell icon so you never miss out on any videos. Thanks for watching.